Hello everyone, I'm Jim Kropog. Welcome to our 2022 Midyear Outlook for the economy and the markets. I'm going to spend the next few minutes discussing what's happened so far this year and why. But most importantly, I'll talk about what we see for the remainder of the year and how investors can navigate the current environment. Let's get into it. The first half of 2022 has certainly been a tough stretch for the global economy, as well as for the stock and bond markets. Year to date, the broad U.S. stock market, as measured by the S&P 500, is down 17%. Technology stocks, measured by the NASDAQ, are down 26%. And even bonds are down 9%, which is rare. In short, there have been few places to hide from the market sell-off so far this year. So how did we get here? Well, the global economy is currently dealing with a myriad of issues. First, COVID caused governments across the world to react by shutting down their economies, which we did here in the U.S. in March of 2020. In order to keep the economy afloat, the Federal Reserve lowered interest rates and printed money, which essentially means they flooded the banks with money, which they could then lend to individuals and businesses at very low rates. At the same time, the federal government provided support to the economy in the form of forgivable loans to businesses, stimulus checks to individuals, and increased unemployment benefits. Now, it's important to note that these policies were implemented across the globe, not just in the U.S. These policies worked. The economy stabilized, and the unemployment rate and stock market quickly recovered. However, you can't shut down entire economies and not expect supply chains to be disrupted. As economies opened back up, there was pent-up demand from consumers who were now flush with cash from stimulus money. But supply chains have never caught up to this demand. Whenever you have increased demand and limited supply, you get inflation. And it didn't help that Russia's invasion of Ukraine and the subsequent sanctions has caused additional supply issues, as much of the world's commodities such as oil and gas, wheat, and corn come from Russia and the Ukraine. And so we're dealing with a global inflation issue. Now remember, the role of the Federal Reserve is to control interest rates and money supply in the pursuit of full employment and stable prices. The challenge they have now is to bring inflation back down closer to their 2% target. They do this by raising interest rates. If it costs more to buy a house or expand a business because of higher interest rates, this will lessen demand. Less demand will lower prices. It will also allow supply chains to catch up with demand. Remember, everything comes back to having the right balance between supply and demand. Now the key is, can the Federal Reserve suppress demand enough to tame inflation without causing a recession, the so-called soft landing? Well, that remains to be seen. It's important to keep in mind that recessions are a normal part of the economic cycle. A recession is simply the cooling off of an overheated economy. In fact, as this chart shows, we've had 12 recessions in the U.S. since World War II. And in each case, the stock market has always recovered and moved to new highs. So, with all of this going on, it's no wonder that stocks and bonds have been pulling back. If you've been brave enough to look at your IRA or your 401k statement over the last 6 to 8 months, you've certainly seen your account values moving lower. If I had to use one word to explain it, it would be uncertainty. When businesses and individuals are uncertain where interest rates and inflation will be in the future, they have a tougher time planning for it, and thus are more hesitant to spend and invest. This slows down the economy and affects corporate profits and thus stock prices. So, when will we see the bottom of this market downturn? When we begin to see inflation peaking and beginning to move down. How long that will take, no one knows. But it won't happen overnight. It's going to be a gradual process. In the meantime, unemployment is low at 3.6%, which means that people are working and still spending. And consumer spending drives 70% of our economy. If we can keep unemployment low while inflation begins to move lower, we may be able to avoid a recession, or at least it'll be a mild one. Our base case is that we'll continue to see a strong labor market, inflation will gradually move down, some of the economic uncertainties will become more clear over time, and if we do have a recession, it'll be mild. But at this time, it's just too hard to predict. Stubbornly high inflation, a potentially overly aggressive Federal Reserve, new COVID variants, and possible broader military conflict in Europe still present significant risks. So, as an investor, here are 5 things you should be doing during this unsettling time. Number 1, don't panic. Fear makes for poor decision making. Number 2, don't try to time the market by selling everything to cash and then attempting to figure out the exact time to get back in. Numerous studies have consistently shown that attempting to time the market is impossible and could lead to a costly mistake. Number 3, know what you own in your portfolio. If you own stock in strong, profitable companies with competitive advantages, companies like Apple, Google, Amazon, Home Depot, Pepsi, Eli Lilly, these companies should weather this storm and provide growth and value to investors over the long term. As mentioned earlier, year to date, the S&P 500 is down 17%. However, if you widen your lens over the last 5 years, you can see that even after the latest downturn, the S&P 500 is up over 60% or 12% per year. Number 4, if you haven't already done so, consider using alternative investments in your existing portfolio of stocks and bonds, such as real estate, fixed annuities, or even CDs. It's times like these that illustrate the importance of diversification. If you'd like to learn more about these options, just let us know. And number 5, communicate. We do our best to stay in touch with you via our monthly minute video series, periodic client letters, quarterly e-newsletters, and our semi-annual market outlook, like today. And of course, we meet with you regularly to review your investment portfolio and your financial plan and make sure that you're staying on track towards accomplishing your financial goals. But be sure to reach out to us with questions or concerns that you may have. Thanks for watching, and as always, thank you for your business. We'll see you next time.